So welcome to Budget 2026 breakdown. This one's obviously taking a bit more time this year than we have in previous years because there's obviously quite a lot to unpack. So we're going to go through a bit of a short summary of the sort of key highlights because there is quite a lot of detail, but there's some simplicity, I guess, in terms of action steps. So we'll talk about that first. And then a number of clients have asked us for some pretty detailed sort of deep dives. So we're going to spend a bit more time. We'll timestamp that. You can sort of go through bits and pieces that you're interested in, but we do want to try and give as much depth of detail as we can. So, Calvin, Budget 2026.
A great time.
Exciting time. It's kind of it's almost like a bit of a return to the old school days of, I remember sort of, 15, 20 years ago, you'd sort of hang on that Tuesday night because the changes would give us a whole bunch of stuff potentially to do within a few weeks or before the end of financial year or kind of whatever, and that kind of went away. So this is a bit of a return to that. But as promised, we're just going to do a quick overview of what I call the sort of super short version, right? So so there's a whole bunch of changes people are mostly interested in. What does this mean for family trusts and whether they're sort of active trusts or ones that are running businesses or passive ones and just owning investment assets essentially. Keep in mind that managed funds and super funds are also trusts. So what does it mean for super? Mm-hmm. Rental property has obviously been a massive one in the spotlight. So we'll spend a bit more time on the deep dive on that in particular. What does it mean for small businesses and those people who are sort of trying to get towards retirement and sort of cashing out their business? And the other one is testamentary trust. So what does it mean? Hey, I've got a will, I've got testamentary trust set up in my will, or at least outlined to be set up in my will. What does it kind of mean with that, right? And I guess the number one question is always like, can we do much about this sort of thing? And the answer to that is, luckily, fortunately, unfortunately, not always yes, definitely. But the good news is we've got a bit of time. So first of all, obviously, like all of these things, there's no legislation yet, which is probably more often than more in this case than generally is that it's very likely that all this will pass, whatever the legislation is, because they basically own both houses. Or the support they need is more supportive rather than less supportive. So yes, unlike many years where we say, look, don't do anything because no idea, a bunch of this won't get passed. It probably will, unless the government changes their mind, right? So I don't think it's going to necessarily need as much horse trading as other years, but that still could happen. So we need the legislation, but the main reason we need the legislation because the devil's always in the detail with these things, and that's where the not necessarily loopholes, but that's where the minutiae can really matter in terms of the way you go about things. So we really need to see that first. But the other thing the government made pretty clear is we've got until July 2027. So the 2028 financial year is the first year that most of these things are likely to take effect. And they've also said, hey, we're going to give rollover relief and we're not going to penalise you right now for restructuring. At least that's the intent. We'll talk about some cases where that is fundamentally not true, but that to go. So a bottom line is no one, from anything we've looked at, no one needs to rush out and do anything like right now. Mm-hmm. I would say there's an order of when certain people should, like who we're going to do with first, right through to who we're going to leave alone. There's been an order that we'll talk about in the detail, but there's no one really, we're rushing out sort of contacting clients, say, hey, we need to hurry up and do something before June 30 this year that's materially different to the plans we'd already have in place. Because in reality, what this is going to do structurally is mean everyone's going to have to do a lot more tax planning than they did in the past. So let's start with the winners. The winners out of this are people like us, to be honest, like advice. I would say accountants as well, but accountants they're struggling to do the work they're already faced with. So, and get the staff to do the work sort of thing. So it's, so I don't know that they're necessarily winners per se, but there's a hell of a lot of work for financial advisors, particularly because we tend to be at the two ends of tax planning, right? We tend to be the proactive side before financial years start, whereas accountants tend to spend a lot of their time more historical. But we also deal with the end of life things, right? We deal with clients who are selling businesses and transitioning into retirement. We'll talk about the nuances of that, particularly when we look at some of the potential changes from a capital gains tax point of view and what they mean. So we're already really well positioned for this, for the vast majority of our clients, and we won't need to do anything materially different this year or next year potentially, so we do have a fair bit of time. So the super short version is no one needs to run out and do anything right now. We've got enough time to sort it out, and it will be really as part of the general sort of tax planning, but the direction will change, right? So So the winners, again, people, financial advisors, we're going to have plenty of work to do. There's no doubt about that. And the value of that work is going to be massively increased. So you could argue the public sector, anyone who's involved in the public sector, they're winners because it doesn't look like there's any massive job cuts that to continue to expand. And ironically, the real winners out of this actually, at least proportionally, are, or comparatively, are people with assets. So despite a lot of the rhetoric, and we'll get into the detail of this, but despite a lot of the rhetoric in this, the real losers out of this are young people. Like, without question, mathematically, they are massively disproportionately the losers out of that. So we'll delve into that a bit as well.
Especially if you already own, like a house, for example, those negative gearing.
Well, it's actually probably more if you don't, right? Because you won't get, we'll talk about that when we go through some of the mathematical aspects of the nature of these changes, right? But if you're a young person, there's so many things now that have been available to even someone, but certainly say my parents and baby boomers coming through. So many things that have been available to them, which have resulted in the accumulation of capital that are not going to be available under these changes. The compounding effect of that.
Sorry, I was saying if you already own assets, then, like especially housing, then you're 100% a winner as opposed to a loser.
Yeah, more so. But even that's will be dependent. So young people, entrepreneurs, business people. This is, we'll get into the sensibleness of it thing, but the idea that this is a productivity enhancing budget, that's nothing could be further from the truth. And the negative gearing aspect means that the beginning of things is way less beneficial. So again, young people are disproportionately affected by that. Probably the one that I think will become more clear that people aren't necessarily talking about so much at this point, the massive losers in this are actually small business owners. And when I say small business owners, I mean the sort of businesses we refer to as cash cows. So businesses that aren't trying to become very medium to large businesses, they're not trying to become genuine enterprises. Mm-hmm. And so we'll talk about that when we talk about tax planning, but they're massive losers in this because they're not going to have much alternative compared to what they've done sort of historically. And I think, the other, I think it's very hard to look at this from a fundamental perspective and say that as a, society, the economy, however you want to sort of measure the collective benefit, that this is a good path to go down, and we'll talk about some of the reasons why that. So in terms of like the way we'll go through this, we'll look at some of the basic parts. We'll look at changes to capital gains tax and trusts, and particularly how like the whole government spending versus revenue sort of calculations. Because a lot of what we see with a lot of these things is that the classic scenario we often talk about of like using the truth to tell lies, right? So some of this is you'll see graphs, and we'll go through a couple of examples where people will use data where the data itself is accurate in terms of, it's been accurately collated, if you like, but it's used, it's either used in a way that is very disingenuous into what the data actually represents, i.e. that data doesn't represent that at all, or it's used in a way to suggest it represents something that it doesn't. And in particular, we'll talk a lot about the conflation of statistical categories with real people, right? Because I think that's the one big thing that, to me, that runs through this entire thing is looking at data with a very limited context and not understanding that data, how that data represents or doesn't represent the actual real world. So we'll talk a bit about that as well, because I think that goes to the heart of a lot of the confusion people will have around who does this really affect and how, right? And we'll look at things like productivity measures and what the government sort of talking about around productivity, because to me, and we'll talk about this when we talk about the sort of player principle I use to understand these things. But it's a bit like getting the government to drive productivity is a bit like trying to get the ref to improve the quality of the game. Like it's just that's not their job. Right. So we'll talk about what does it mean for super. We'll look at trust. I don't really sort of want to necessarily talk about this as a good or a bad budget. I think we'll just lay out the implications, potential implications, and people can make their own, because qualitative is always, again, very contextually based. Again, it would be hard to argue for someone who's in the business of advising people, it's hard to argue that isn't at least a good budget in some way for a business like ours, because the demand will be increased. But a lot of people have asked me in particular to go into like why they're doing this, like what's the ideology behind it, what's the thinking behind it, what is it they're really sort of trying to do and why. And there's a few things we need to I think unpack in terms of, well, why are they doing this now? What's behind it? Because that also gives us a little bit of insight into maybe, if there are changes, what might they be, and is this the beginning of something, or is this a continuation of the theme, or what else can we expect? Right. So let's get into it. A few things I think to keep in mind initially, right? So I guess you've got to understand, first of all, that all budgets, first and foremost, are political instruments as opposed to, fiscal or economic, right? So I would say political first, which again might seem a bit crazy, but we'll get into the timing of this. Fiscal second, because at the end of the day, it has to be about the short-term government spending, if you like. And they have an impact on the economy per se, but they don't have anywhere near the impact that governments might like to claim they do. And you can always sort of tell this because both sides of politics in Australia will sort of argue whether they're a better economic manager. And again, it's like arguing who's the better referee. And at the end of the day, well, it depends on what you're trying to get out of the game. It depends. But they're both referees. So they're not... they're not... They don't play the game. They don't make the game, right? They have an influence how the game can be played, but they don't make the game. So you've got to look at that in terms of what I would say the order of results, right? So you've got to think of politically first, and there's different motivations of that. You've got to look at fiscally second, what they're trying to do in terms of balancing income versus expenditure. And again, we'll talk a little bit about trying to understand that from an actual government perspective, because again, I think a lot of times people misunderstand the way economics and government policy works because they think of the government like a household. Okay, because that's all they experience, right? So our individual experience is, we run a household, we run a budget, we have income, we have expenses, we have assets, we have liabilities, and so does the government. And the government uses those same terms, okay? But the definitions the government uses, or Treasury, however you want to describe it, uses in some of these terms are actually slightly different, and therefore in some cases fundamentally different in terms of, so we want to talk about understanding that nuance, because understanding when government revenue versus your revenue, government expenditure versus yours, etc., and what do they mean with that, we'll go through some actual examples from Treasury itself, because I think if you understand that, it goes a long way to understanding, let's just say, some of the claims, okay, versus reality. All right, because I guess, again, if you look at the extremes of that, you could say, well, surely it's in everyone's interest for us to have a strong economy. And that's absolutely true, right? But we always have this sort of dichotomy of advantages versus interest, right? So is it to your advantage to do something? Well, will I get ahead by doing so? Well, if I gain an advantage, but it's not in my long-term interest to do that, well, then there's always a sort of balance, right? And we have as a society, if you like, worked out that, hey, if we do things that are actually in our interest, we can continue to play the game harder and better and more proactive, and it's in everyone's interest to sort of do that, right? So sometimes things that might be to our advantage are counter to our advantage. So like if we go and steal stuff, it's to our advantage if we steal stuff and we get to keep it because we have stuff we wouldn't otherwise have, right? But that doesn't scale. It's not in our interest. If we all just steal stuff, well then everyone's just going to spend all their time protecting, not growing the pie, if that makes sense, right? So what's to our short-term advantage is often not in our long-term interest. But by the same token, if there's no penalty for just satisfying those short-term interests, right? If we're not punished if we steal stuff and there is no, there's no penalty to pay as a result of that, not taking advantage is actually economically the dumb thing to do, right? Because if everyone's looting, not joining the looting means there's nothing for you. So you can't wait until the shops resupply and everything's fine, because they just won't, right? There won't be anything. So we got to really be careful if we tip over that advantage versus incentives. And that's always a problem in politics, right? Is because the difference between me and a politician is they've been elected and I haven't been. And so at the end of the day, I can have whatever view I like, but until I get elected, I can't actually have any influence, right? So number one thing is get elected, then you can worry about what you do. And so we always have to sort of got to get that. It's not an excuse, it's just understanding that that's one of the constraints, I suppose, in terms of making these decisions. So I guess what that means is if you look at it from an incentive perspective, again, people who join politics normally believe, at least to a degree, that government should be setting the rules and controlling things, right? That's going to be more of a default sort of, okay. So you're going to, and the people who rise to the top in those environments tend to be more so to those extremes, okay? So you're always going to get, whichever side of politics you talk about, you're always going to get people who are relatively more extreme at the top of of what you'd say is the guiding ideology, okay? And so whenever you see a government in their second term, in their second budget of their second term, is always kind of like peak, what can we get away with, right?
True.
Because the first term, they're blaming the previous government for the mess they're in, and they're doing the whole CEO thing of writing everything off and dragging everything down. They're trying to get front of the table. They're trying to work out who's the right minister in right department. They're probably shuffling departments, doing all those sort of things to sort of set things up. 3-year term, they're really not getting, even if they get the whole 3-year term, they're really not getting much more than their feet under the desk and sort of starting things going. So it's the second term where a government now has, feels like they have a bit of momentum and the opportunity to do something, right? So, but if you think about those terms, right, well, the budget just before an election is a winning election budget, so you can't use your third budget, okay? The first one is, again, we just got back in, we've got to get the house in order sort of scenario, and often, depending on the timing of the election, might be a bit soon. So the second budget of the second term is always kind of, because they might not get a third, right? Every government knows thirds are promised to no one, so, and the fourth is even harder. So if they're really going to have a crack, tends to be in that sort of second budget of second term, which is exactly what we're faced with now. So it doesn't surprise me that if Jim's going to have a big swing of the bat, this is the term. And he actually, if you read his sort of manifesto thing he released a few years ago, that gives you a lot of insight into his thinking and what he thinks the role of government is, etc. And so this budget sort of leans very much heavily into that. So yeah, I guess this is a budget where you can get peak government belief, I guess is probably the way to describe it. So, and so, like, what does that mean for the rest of us? Okay, well, I guess the good news is to some degree is, like I said earlier, governments really they have an impact on sections of the economy, and they can influence how, again, the best way to think about this is they set the rules for the game, but in reality they're more like the referee, right? Because they set all the framework for the regulation that's going to be enforced, right? And the legal system, particularly the tax system, because it's a self-reporting, is the tax system operates in a way that, like if you want to go to the judiciary, you pay, right? So the ATO sort of sets the rules based on what they interpret the law to say, and it's up to you to prove otherwise. It's kind of how it works. So in other words, they're really more a referee than they are of purely just commanding the rules of the game, if that makes sense. Okay. So I find it useful to look more in that sort of analogy. So again, pick your sport, but in most sports you say, well, the best games are where no one noticed the referee. Put the whistle away and just let the players play, right? But by the same token, the players are always going to be, especially the very best players, are always going to be trying to push the envelope, right? They're going to be trying to how hard can we play this game? Because the harder we play the game, the more exciting it is, more fun, better spectacle, and so on and so on. But, if there's sidelines for a reason, right? There's goalposts for a reason. So we need to have some things need to be relatively hard and fast, and some things need to be a little bit more sort of flexible in interpreting. And that's where I think this budget really hones in to say, hey, there's some bit of gameplay that this particular government is just fundamentally against. And we'll talk about this particularly when we talk about trusts and the capital gains tax rules and what's the thinking behind why they've done this. Is because there's a part of the gameplay that they've just fundamentally opposed to. And that's really kind of what they're going after. So, all right. So where do we start? Well, I think probably the first thing to, I guess, the way I sort of come at this is, how do I think they've got to where they've got to, and do I think it's the right way to go about it? And like everything, you've got to start with the premise. Okay. So why are you changing the way tax is generated? There's really two reasons. One is either you don't think the pie is being distributed properly. Okay. So I'm not paying my fair share. Okay. Therefore, you're paying too much. So it's a zero-sum game, right? So if that's the premise is like the system's unfair, well then let's work out a way where I pay more and you pay less, because it's the fairness of the system is the issue. So that's one issue. Yep. Or is the pie just simply not big enough? Or do we need more money? Okay, so we'll talk about those two things separately, because they're two very different things. Because if the pie's not big enough, then it might be a case of you don't pay any more, or you pay a little bit more, and I pay a lot more. It might be I pay a lot more, you pay a bit less. Like there could be a balancing as well, but they're two different things, right? Is the pie big enough, or and it just needs sort of redistributing, okay? Or and maybe not necessarily the distribution, or maybe the incentives are wrong, right? The incentives aren't there to allow the game to flourish, right? Or is the pie itself not big enough, right? So they're the two issues. Okay. The other big thing I think that is lost in a lot of the terminology is the government treasury talk about costs and expenditure. Okay. Now, and the terminology they use various sort of forms of this, but they basically look at expenditure as costs, but they conflate concessions they've provided with actual physical transfer of funds. Okay, so there's two ways that the budget will look at a cost. They'll look at things foregone, so foregone revenue. So a classic example will be, we tax superannuation concessionally, 15% on contributions as opposed to an income tax, right? Or in retirement, there's concessions on money in earnings and super. Okay, so Treasury tries to, and we'll look at some examples of this, they try to estimate what those concessions are, and they put that as, and they refer to it as a cost to the budget. Okay, so revenue foregone, in their terminology, is a cost. Now, again, is that a right or wrong thing? Well, again, contextually, it's a valid thing if you want to track what you think the relative impact of a policy is. Fine. But there's some problems with it. First of all, it assumes that everything else is equal, that there will be no behavioural change as a result of you changing the landscape. And we know that always is. In fact, it will be with this one, right? So using that as a way to determine what's going to happen to your budget, which is, again, one of the reasons why they're almost always out in terms of forecasting, you know. And we'll talk a little bit about that and how that's changed over time as well when we get into some of those weeds. But the idea that if a government pays a subsidy to someone, physically pays money, versus decides not to. Okay, and I think we need to we'll do a separate video on this, a deep dive into probably the best example of this is rebates for diesel, right? This is probably my pet peeve in terms of this. So if you look at a lot of the concessions around subsidies for fossil fuels in general, but particularly in terms of diesel, right? So at the moment, the government charges an excise on fuel. Okay. What it does is it says, okay, well, because diesel is so important for the economy and there's so much diesel is consumed essentially by farmers and freight companies, right? Moving and growing stuff. They provide them a rebate. Okay. If you look at the way that they're actually accounted for, that's by far the majority of the expenditure in terms of subsidies. So when you hear about fossil fuel subsidies, for example, right, most of that's diesel, and most of that is the excise not charged to essentially farmers and freight. Okay. So if you fill your ute up with diesel, you're paying it. You fill your truck up because you're a transport company, you get this rebate. Well, you don't pay that, so your fuel's cheaper.
Just to clarify, so either for like the concession that they give to farmers and truck drivers for the diesel, or for the superannuation system where we have concessions where people
didn't pay tax on that earnings. Yep.
When people talk about a government deficit, so like that's if my household has a deficit, that's my income is less.
You physically
than my
have
expenses.
bills that you aren't paying. Yeah.
Or I'm dipping into savings to pay for it, or whatever it happens to be.
Yeah.
Do those flow through to a government deficit, or is it?
No. So government deficits the way you think. We'll talk about that when we look at that. But that's an impact to revenue. So whenever the Treasury come in and say, oh, look, the cost of the budget of this is revenue foregone, is a cost in their forward calculation. So they look at basically 3-year and 10-year projections, right? They say, okay, well, if we do this, we make this change, we give this concession of the fuel excise, for example, and we give that's money we're now not going to collect. Now, you could look at that and say, well, how realistic is that? Okay. Now, with something like diesel, you could probably say, well, actually, it is probably pretty realistic in the sense that, yes, if the price is higher, there'll be less of something consumed. And that would probably even be true in the case of diesel. But the problem and one of the reasons why they give this concession is because without diesel, stuff doesn't move. Okay. And there isn't really any choice Most of the stuff still has to move. The price will just be higher. Okay, and therefore it's not that will suffer. It's what are the substitutes you now can't spend money on because it costs you more to get everything. And because energy compounds cost, because there's multiple inputs of energy across the supply chain, if you do that early and you make that cost better, it amplifies everything all the way along. So it's a good idea not to tax that if you want to keep the costs of things down. Does that make sense?
Yep.
Okay, but to turn around and say, we decided to put a levy on water, right? Arbitrary, okay. But we're only going to charge people who get water and put it into soft drinks or beverages, right? Your water at home, no problem. We're only going to charge water for Coca-Cola or beer companies or people turning it into an actual product of beverage, right? First of all, it's a completely arbitrary cost. It's the government deciding to raise revenue that way as opposed to it was a GST or some other arbitrary thing. But who's getting that discount?
Isn't the discount for not having water charged a levy that comes out of your tap?
Yes.
Nobody, I would say.
Who's getting the discount?
Well,
so if the water comes out of your tap, you don't pay that, but all the soft drink companies do. We'll just use them as an example.
Well, technically, I get the discount, but the net effect is zero. So because I'm not paying the levy, but I'm also not paying the levy. If that makes sense.
So you're not paying it.
Yeah.
The physical payment is being paid by in this case, the soft drink company. So who do you think you would say is getting the benefit of the discount of that water? Is it the soft drink companies? Is it you as a consumer of water at home, or is it the Icon Water or Melbourne Water or whoever's supplying your water in the first place? Who's getting the value of that subsidy?
I don't think I understand the question. I'm sorry.
So Melbourne Water or Icon Water or back to you AGL, whoever's creating the water and making it come out of your tap. Are they getting anything? Are they getting any benefit as a result of that water being produced? Of that not being charged on households versus Coca-Cola, right? Their revenue's unchanged, right?
No, yeah.
Okay. Now, there might be slightly less demand for their product as a result. You could maybe argue that. But at the end of the day, it makes no difference to them. Okay. Coca-Cola, they're physically paying it because they've got to pay that based on whatever their volume is, okay? But you're not.
Sure.
So if anyone's getting the benefit of not having to pay that levy, it's the person who's not having to pay it. Wouldn't you think?
Sure.
Wouldn't that be the most appropriate place to say you're getting the benefit?
I guess so, but I guess my point was my net position is the same because I'm not paying a levy that I wasn't paying before.
Yeah. But now it's being paid, right?
Okay.
Because the government needed the money and they chose to do it as a levy. Okay. So everyone who buys soft drinks is ultimately the one paying it, but the soft drink companies, the beverage companies, they're the ones essentially paying the... Okay.
Sure.
But the way that's, if you look at that in terms of fossil fuel subsidies, because that foregone revenue has made water more accessible, that's recorded as a fossil fuel subsidy. That's, in this case, recorded as a water subsidy, and the benefit is going to the water company. That's how it's reported.
Right, okay. Like, as in, Icon Water is getting my water subsidy,
getting the subsidy
so that they don't charge me tax.
So the excise that you're not paying on the water is recorded as a subsidy to Icon Water or Melbourne Water or Barwon Water or wherever you get your water from.
Right.
That's how it's recorded.
Strange, but sure.
Right? So the people who made the product that the government chose to put a tax on, because the government then chose not to put the tax on a particular cohort, they claim the person making the product in the first place is the one paying that, is the one receiving that benefit. So it's in this case, a water subsidy, right? Because they're not charging a tax on very specific consumers of that product.
Sure.
That's what the fossil fuel subsidy predominantly is, right? Similar to these things. So by not charging super funds, right, it's those people that get the benefit. Despite the fact that that capital is invested, which means companies, utility, whatever the underlying assets are, have that capital available to them and can be used in productive or unproductive ways. We can talk about that in a second. Because I now will have more of that as a result, okay, I'm deemed to get that benefit. Now, you could at least in that case say, well, I'm getting some because there is more money there and whatever. But there's also the benefit of having that money invested and having that cost of capital as a result of that thing. Does that make sense? So I guess the point of all this is to say that when you delve into the way budget allocations are and some of the costs, the argument, go back to that water example, the money you don't pay on that is recorded in exactly the same way as the money the government pays me for a childcare rebate or reduction on my pharmaceutical benefits or whatever, or the physical family tax benefit that gets put, or my Centrelink payment, age pension, whatever. So physical money being paid to somebody is recorded in exactly the same way as the money they didn't collect on whoever they decided not to charge it on.
Right.
Okay. But in the other case, I'm the recipient of that, they call it transfer, if I'm receiving age pension, I'm regarded as getting the benefit. But in the case of many of these levies, the person allegedly, at least politically, getting the benefit is the person whose product is the thing that's been targeted, if that makes sense, right? So, so that's one very pervasive sort of issue in terms of the way budgets are sort of calculated, etc. Again, this is getting into some of the weeds of it, but I guess the point of this is to understand is that looking at headline things, and even in terms of that potential confusion of saying, well, hang on, is a budget deficit, is it an accounting trick, or is it a real sort of cash flow thing? We need to delve into that and saying, well, where is money actually coming in, where is it going? And the money that isn't coming in, to call that a cost in some context is a good idea when you look at it from a policy point of view, but in terms of like how you're running, it'd be the same thing as saying, well, because we chose not to put our fees up last year by $100 per client, the cost to our budget is $1 million because we had 1,000 clients that we didn't charge $100 for. That's the cost to our budget. Now, that's a good idea when we're looking at business planning and saying, should we put our prices up versus doing other things? But to turn around and claim that that's the reason why our business is unsuccessful is because of the cost of the budget of choosing not to charge people more is not, it's just not a sensible strategy. So that's one thing. The other thing that I think people really don't appreciate, and this is getting to that sort of using the truth to tell lies scenario, is very often either deliberately or accidentally or naively, is people tend to conflate statistical categories of things with real people. Okay, and we'll look at that especially when we look at trust, for example. Okay, that they say, okay, well, this cohort of people statistically measured is getting this benefit or in this situation, as if those people are the same people through time. Okay, the classic scenario is, is easy, you look at poor people. You say, well, poor people's share of wealth, whether it's income or capital, that versus, the top quartile or decile or whatever, and we'll look at some examples of that. So, okay, well, so that's, the gap between those two things is getting bigger. Now, that's almost certainly true in some cases, but you need to look at, well, how is that measured and why, and who are we actually measuring? Because if that was true, that if you're a poor person and you stayed in, let's say, the bottom quartile your entire life, and there was no way to move between that, well, okay, then that's a very different scenario of like, well, when you analyse who the poor people are, it's all the people under 18 are the poor people because they're children. But they're all probably living at home and they don't need a lot of income, right? Now, if the poor people were all 50-year-olds, that would be a very different scenario. So the question isn't, how many people are poor or what's their level of poverty per se necessarily, but do they stay there? And again, it's relatively, even across countries, almost no people stay poor their entire life. Certainly people are, and I know people, I grew up with lots of people like that. But in terms of actual numbers of people, they're very, very few stay poor their entire life. And it is true that a very large percentage of those people stay poor either because they really don't have any choice, right? Because of some disability or something like that. There's just no way they're getting out. So there's that cohort. And there are a cohort who just choose to. Okay, I've got a handful of family members who will stay in that category their entire life. Okay, and they're happy as Larry. Like they just physically choose to do so. They don't want a lifestyle that requires anything, and so they'll stay at the absolute, massively below the poverty line because the lifestyle they want to live excludes them from that measurement, sort of thing, right? So again, Is that a problem? No, that's very much a choice. So there are some people that's not a choice, but the vast majority of people in that category don't stay there, and even a very reasonable portion of those people are relatively easy to identify. Who do you want to help versus not help? So, and finally, I think the other thing that's really, I guess, a dangerous precedent that will be fleshed out a lot more, I think, in the coming months, that this budget is attacking is and Chalmers sort of talked about this when he talked about he made the comparison, and he's made it a number of times in press following, where he said it's not fair that someone who earns their money as income is taxed at a different rate to someone who earns their money through a gain. Okay, so I want to pull that apart a bit, because I think that really goes back to the underlying thinking and the belief system behind why they're making these changes, and where the biggest mistake and errors, I think, are and consequences. Okay, so we're going to sort of go through some sort of more concrete examples and some numbers in a second, but what does this mean? Well, what it means an acceleration of something that was already happening, right? Is that once upon a time, no one had any money, right? So almost nobody really did much tax planning because no one really had any money. What happened and has happened over time, and in fact, I might jump straight to this graph because it kind of really highlights the point of it, is what happens is, over time, everyone gets money. Okay, let's go with this one. Okay, so this is from Treasury. Right? So this is the cumulative increase in the number of taxpayers. Okay, so this is the number of taxpayers on this side here. This is the top marginal rate, 45%, so plus Medicare it's 47, and then this is the next highest, 37. Okay, so this is back sort of 10 years ago. This is only 2025, obviously. So you can see here that there was maybe, 240 odd thousand in the top two?
Yep.
Okay. Whereas in 2025, you had almost getting up to now 2.5 million just in that bracket, second top.
It's a much quicker increase in population. So it's an increase in proportion as well as an increase in actual numbers. Is that a fair comment?
So this is looking at absolute numbers of people.
Yeah.
It's looking number of individuals, taxpayers, who are in that bracket. Okay, and so we're now up to 3 million people paying the top two tax rates, right? So paying more than nearly 40% or more of their income being in income tax. Okay, but the number of people. So back here, it's like almost no one was on top marginal rate. I don't know, that's maybe 50,000, maybe not even that, right? Okay, whereas up here, we're now talking, what's that? 700,000 people.
Something like that.
Okay. So probably something, what are we getting? Maybe a 15-fold increase in the number of people. Now, we haven't had a 15-fold increase in population.
Yep.
So we're getting a massive disproportion of wealthy people being pushed into that tax bracket. Okay. Yep. This is only 10 years, right? But this is the next one down. Again, what are we talking here? Maybe 200, 250? And we're talking, so again, probably getting up to 10 times the number of people that have been caught in that bracket. Okay, for two reasons, right? One is, okay, this population growth, yes, but again, hasn't doubled. Okay, certainly hasn't gone up 5 or 15 times. But the level of income, because the level to relative wealth, and there's two things driving that. There's inflation, we'll talk about that a little bit as well, inflating the actual number. But because those tax rates don't really change, the bracket creep they talk about, you're getting this massive explosion in the relative rate of tax that people pay. So back here, not that many people really needed to do a lot of tax planning. But here, what are we talking? 10 times as many people now have to do tax planning, right? As what did only 10 years ago. Now, you can imagine if I extrapolate that graph out, with no real change in these marginal rates, and again, the opposition have come in and said, hey, this is extracting. We need to at least index these because look at what this is doing. In fact, I haven't been able to find some solid numbers on this, but it's somewhere around, I would absolutely be willing to bet, I'm going to say somewhere at least 80% of the budget repair, if you look at the spending over the next 10 years, if you look at bracket creep and the commodity boom extra company tax, right? Not mining royalties or any of those sort of things, looking at the actual company tax. The increase in that over the expectation of the budget plus bracket creep will be almost all of the government savings from the budget in the next 10 years, right? So in other words, the idea that that this government, and they're not unique in this aspect, is being fiscally responsible in terms of expenditure versus income, it just isn't true, right? So they're not even remotely trying to balance this thing out in terms of what they do. They're relying on essentially inflation, okay? Inflation twofold. One is the compounding effect of wealth growing, but inflating that faster, and we'll talk about the math in that in a second, so that more people get pushed into that. So you've got this huge revenue stream. So again, if we look at this from a tax revenue growth perspective, okay, so this here looks at the actual tax revenue collected. This is all governments, but you can see here, you know, the 839 billion in 24-25. If I go down to that, you can see that Commonwealth government is by over three-quarters, the vast majority, probably 80% of that. So this line is, you know, this is really federal government sort of driving this line.
Yep.
Okay, and again, this is the ABS, so should be reliable data. So this is the amount of revenue. So you can see back in 2015, 463 billion in revenue, 840. So almost doubled the amount of money in 10 years.
Wow.
Now, a business that doubles its revenue every 10 years, okay, we know the law of 72, that's around about a 7% per annum growth, okay? And again, if we look at this, this is the rate of growth here. See 4 to 5, out to 8, back to 5. Here we're talking COVID, coming into COVID, right? So negative, but really that just gets balanced up with a 15% increase there. So you can see we're still, what are we here, 8, 9% here, 6, 1. So we're seeing a 7% per annum growth rate in government revenue. Okay? So if other things aren't changing at that rate, the only effect of that can be that tax as a percentage of GDP, and we'll talk about the bluntness of that measurement. So this is going back to 1970s. Okay, so this is World Bank data, but it's based off ABS ultimately. So you can see here that this is the share of government revenue to GDP. Now, in the budget, this is only about 2022, in the budget zone, they're now saying we're up to 30 in 2025.
Wow.
Right? Now, this is, okay, so revenue, government spending at one point in time was back here, 20-odd% in the 1980s, right? It's now more like 30. Okay. All right. So what does that mean? Well, it just means that the government's got more money, relatively. So what's the impact of that? We're putting more in the hands of the referee than we are in players. Now, we can argue whether that's a good or bad thing, but there's no doubt that that has implications, right? Because, again, if we look at from, you know, the what I look at in terms of what I call the player principle, right? So you have people who create value, okay? You have people who amplify that value created. I'd say that businesses like ours sort of sit in that. So you've got your farmers, you've got your miners, you've got your, you know, your builders, you've got people who actually physically make stuff that the world relies on, okay? This computer, all this sort of stuff that sits in this room today, someone made this stuff and it sure as hell wasn't me, okay? Yep. So someone had to make it. Okay, now, someone like me might be able to take a bunch of those things and say, well, that's just a TV screen and this is just electrons flying around, whatever, but I can bring together a whole bunch of different things and amplify the value of those things in a way that is potentially even more valuable because I'm now applying more intellectual capital to this rather than the physical capital that someone made or the food someone grew or whatever, right? So yes, it's easy to concentrate and amplify that. So there's more value created that way, especially in the modern world now, intellectually than there is physically. But all intellectual capital relies on physical capital. If farmers aren't feeding me and if builders aren't building stuff and people aren't manufacturing, all that stuff's not happening to make this stuff, I'm not doing all this, okay, let alone AI and all the amplifications of that, right? So we have to understand that at the end of the day, the only thing that matters is the physical. Because if you don't have that, that's the foundational, okay? Then we need to apply energy and all that sort of stuff. So we need physical, we need the energy to sort of to drive that. Then we can get into saying, well, what should people do with that value, right? Now, if we're extracting that and then redeploying that, which is essentially what government revenue does, right? Because keep in mind, the government doesn't create anything. Now, that's not to say there aren't some government departments who are going out and competing with the private sector or sort of making stuff or, doing hospitals or schools or those sorts of things, okay? So, again, we want to separate the commercial from the social in some respect in terms of the nature of the benefit. But stuff still needs to be done. Even when governments build stuff, more often than not, they contract private companies to sort of do so. But people have to go and do stuff. Collective rule makers, and let's put governments into that bracket, aren't the ones actually doing something. Anything more than I'm someone who actually does something. I manipulate things that other people do in a way that hopefully creates enough value for me to feed off the chain. But make no mistake, without those people doing those things, none of what I do has any value if I don't have the tools with which to do it. Government's very much in the same boat, right? It's that they're a drag on other people's productivity, okay? Just as I'm a drag on other people's productivity. In my case, maybe I can amplify total productivity because of the way that I can interact with all those sort of things. And we could argue that governments as the sort of the arbitrators, if you like, of the way that these games are played, can absolutely help to make sure that, things are enforced and things like property rights and we all play the game well enough together that we all can keep playing the game as well as possible. But by definition, referees are a drag on the game. Okay, they have to be. A necessary one, can't have no referees, right? Can't have no rules in the laws because too many other things are not allowed to play out. But the more referees you have, the more times they blow the whistle, the more drag they're going to win the game. So that's always the balance. So the conversation has to be had in terms of like, going back to that conversation I was saying, is it that pie's not being split up properly? Or is the pie not large enough? All of this underlying stuff in this budget says to me, it seems to be, it seems to be couched as the wrong people are paying, okay? We'll talk in the political message in that second. But fundamentally, what it absolutely is doing is saying, hey, we need more revenue because there's more things we want to do and there's nothing we really want to stop doing. So we need more revenue.
And that's backed by the fact that, like, the percentage of GDP of tax revenue, which is essentially government spending, is increasing more and more. So,
okay, so here's where it gets, here's where it gets potentially a bit sort of compoundingly scary. What is GDP? How is it measured? This is very simplistic, but it's close enough to be true. So when you make stuff and sell stuff, that makes that number of GDP go up. It's the output of the economy. So wages are one of those things. Okay, so if I pay someone $100,000 to grow food and supply me with food, that $100,000 goes into the GDP numbers.
Yes.
If I pay you $100,000 to go and rip up that paddock and destroy all the crops, that $100,000 goes into GDP. It's exactly the same measurement. Yes. Okay, now, that's an extreme scenario, and I'm not suggesting that government's around there digging up cornfields, right? But the measurement's exactly the same. So you have to be really, really careful about, delve into that numbers and where does that revenue come from, increasingly. And almost all of the increase in, we could look at the actual government wages, right? Where was that one? Oh, it's on a different one. I'll add that in the handouts. But if you look at the increase, so in the Albanese government, in their first term, payroll to public service increased by roughly 25%.
Ooh. Is that inclusive of contractors?
Government payroll.
Okay.
So the size of the bureaucracy has increased in terms of numbers. And in fact, and I did hear this, but I haven't been able to verify the data, but it does seem to track with the other numbers. Most of the employment growth in the last 5 years has been massively disproportionately, maybe 80, even as much as 80%, has been in the public sector or public sector adjacent. Most of that employment growth has been in that sector, which tracks with, if you look at that revenue growth of wages in terms of public sector. So a lot of the revenue that's being spent, right, is being spent by literally government spending more on that sector, particularly hiring more public servants, right, let alone contractors and all that thing. Okay, now, again, if we follow the dollar and say, we're paying wages of public service, public servant. Okay, well then that goes into GDP. So the question is, how productive is that wage? Okay. Now, you could take one angle and say, well, every referee is unproductive. All they do is slow the game. Okay. Now, whether they're a drag on the game or an absolute parasite, we can argue, but there's no doubt they're a drag on the game. Now, some is good because dragging the game and keeping it all in balance allows the game to grow and expand faster. Absolutely, that's agreeable. And no one knows what the number is, right? But you have to be really, really careful. You say, well, if we add more referees, we add more regulation, we add more legislation, we add more people to write that, we add more people to interpret it, we add more people, all of those things is more and more drag on the economy and more drag on the people who are just going and doing things. There's new rules for you to comply with. And we'll talk about this a bit more when we talk about that, some of the impact of that, in particular in terms of housing, right? So we have to be really, really careful, and we have to start having this conversation around saying, well, like, why are we getting where we are? How are we generating more money, more wealth, and going backwards in these relative measures that we're on? Well, one is because GDP is a very blunt measure to measure how productive an economy actually is. Because again, if you say, well, if everyone was a government employee, the GDP would be exactly the same. But everyone's government, who's making stuff? Is now the government making stuff, and we're now, you know, the USSR, or, you know. So it's a continuum that we need to be really, really careful about how we go to, and that I think is one of the really, what would you say, dangerous, pervasive things that is really coming through in this budget. Is like, we're not going to go after setting a hard limit. It was talked about a number of times in different political cycles over the last 20, 30 years, that there should be a hard rule on setting GDP. Now, even that can be gained because, as I said, you want GDP to rise, you just pay everyone more, right? So that can be gained to some degree, but at least it puts a bit of a hard limit to say, hey, there's only so much money you want to spend. This is literally like clients coming to us and saying, hey, Calvin, you know, you're my advisor. I'm struggling to make ends meet. How do I get more money? Now, we see people like that all the time, right? But we say to them, it's really easy to make more money. You just have to do the things that make more money, okay? Most of the time, people don't make more money because they're just not willing to do the things that make more, not willing to work a more dangerous job, more hours, you know, more stress, whatever it may be, in location, you know, different, like they don't want that in terms of relative balance, right? So it's way easier for people to adjust other parts of their life to keep that in balance. The advantage of government is government spends money first and pays for it second. Okay, so they literally go, we're going to spend all this money, and then whatever comes in, the deficits are always funded essentially by raising debt. Okay, which is why the deficit and the actual level of debt matters. Because what that ultimately means is, if you think of everyone's, we talked about this before, but everyone's debt is someone else's asset. Okay, so the effect of that, the more government spend money, the more treasury bills there's going to be, there's more government bonds there's going to be as a result of the government having to finance that debt. So what does that mean? Well, it means the government now has to pay that interest. Okay. So even if interest rates don't move, and they stay steady over time, that interest is transferred, right, from the government to the holder of those bonds. Okay. So who are the holder of those bonds? Well, again, the super funds and all these different entities, but ultimately, the more wealth you have, the more likely you are to own wealth assets like government bonds. So one of the big problems with government debt that people don't seem to have, I don't know, caught onto or recognise is that government bonds are a way of taking money off taxpayers, because ultimately that's where all the money ultimately has to come from, and being paid to people who already own those assets. Okay, so that's an enormous wealth transfer just happening because the government's not. So one of the reasons why governments should balance their budget isn't because they're like you and me, right? You and I, if we don't pay our bills, we go broke. Governments don't, especially if they print their own currency, they don't go broke. They just change who ends up with the spoils of that transfer. Because government takes money in and they send it out. Now, if they don't take in as much as they send out, they print the rest and they send that to whoever gives them that money in the first place. So that becomes a secondary wealth transfer, not just from the, you know, who the government's spending their money with, you know, the contractors or employees or whatever, but there's that increasing wealth transfer now from the people who don't have assets because they're paying tax to the people who do. Does that make sense? Now, we're a little bit mitigated with that in Australia because many of those people supplying those government bonds are super funds, right? And we've all got some money in super. So it's not necessarily as bad as in, say, a country where that wasn't the case. But that's actually one of the huge parts of the wealth transfer effect that we're seeing in people with lots of money, right? Is that it's government funding deficits that's actually increasing that. That's something people aren't sort of aware of. Okay. So the other thing I want to talk about in terms of what's happened in this budget is this sort of concept of capital gains tax. Again, because Chalmers has made that point where he said, if you earn your money as a gain, you shouldn't pay a different rate of tax to someone who earned their money as income.
Yep.
Okay. Now we have a principle on this that we talk about, earn versus grow versus make. So let's just think about that in a physical sense, right? So you earn money, right? To earn money, under my definition, is you deploy your human capital in some sort of commercial way. You say, I'll do this for you and you pay me $100,000 a year. Okay.
Yep.
So the likelihood of you receiving that $100,000 is extremely high. We have a contract. You have an employment agreement that says I'll pay you whatever a month, etc. So as long as you do the things, I have to find that $100,000. Whether I make any money as a business owner or whatever, that's my problem. Okay. Whereas if I said to you, hey, go and do this thing, and if as a result of that thing, you might get $100,000. Well, where's the $100,000 come from? Well, it has to be traded, right? You have to trade something for something. Now, yes, you might have traded your effort to me in that employment arrangement, but with a fixed known outcome. That's agreed up front. We know what that's going to be. But when you trade, so when you get into business or when you go to, trading on the share market or any other markets, right? You buy something hoping that at some point in the future you'll be able to sell it for more. Okay. So the difference with that capital gain is, first of all, you don't know if that's ever going to be achieved. You also don't know over what time frame it's going to be achieved. You know under your employment agreement you're going to earn $100,000 this financial year. You know by investing some money or by starting a business or whatever is going to trade that value, you don't know if that value is going to be received. And you also don't know when it's going to be received, right? So you might find that, yes, you might end up making $100,000 out of your small business that you started from scratch, but are you going to do it in a year? Are you going to do it in 5 years? Are you going to do it in 10 years? Is it going to be maybe worth $100,000 this year, but then the government changed the rules or the Claude Code came out and now it's worth nothing. So you didn't realise anything. So the idea that earnings and making money, trading something, whether it's physical assets, intellectual assets, whatever, trading things for that future reward, the idea that they're equivalents, it's either disingenuous to claim that or it's just flat out stupidity. Like there's no sensible person can look at those two things and say, oh, okay, that's fair enough. So why is he claiming that, right? Well, he's claiming that's what it looks like in a tax return. Okay. So in one case, you earn $100,000 this year. And in another case, someone realised a gain of $100,000 this year. But when did they make that gain?
Past 10, 20 years?
They might have done it Tuesday, trading crypto. They might have done it in 8 minutes. They might have bought an asset the 21st of September in 1985, just after capital gains tax came in, and they've held it all the way up until now, right? And they've finally made $100,000 and they've sold it this year. So there's no proportionate of when that was earned, okay? Or the effort and risk required to do it. You had to turn up and do your job. Maybe you made $100,000, but maybe you had $2 million at risk in doing so, and you only made $100,000, right? There's no equivalence in terms of that number. They look exactly the same in a tax return because, again, and I don't think people appreciate this, there is actually no such thing as capital gains tax, right? There's only what portion of that gain is included in your income tax. Okay. So the reason why capital gains tax is paid is because a portion of that gain, historically 50% if it's been held for 12 months or more, 50% of that gain is added to your taxable income in the year you realise the gain.
Just to clarify, has that changed now that there's a minimum tax payable for capital gains?
So we'll talk about that in a second. But yeah, so that's the current rule. So once upon a time there was none, and then Paul Keating went, oh, hang on a minute, we want some more money, so we'll bring in capital gains tax. But at least he said, oh, well, we should only tax real gains. And then what happened is when John Howard came in, they realised that how disproportionate that was, and in fact, everywhere, most of the countries in the world, either don't charge one, New Zealand don't have capital gains tax, for example, or their rates are similar to what effectively ours is now. Okay.
Now being the 50%.
Correct.
Yep.
Yeah. So in fact, with this move, essentially doubling of capital gains tax. So it's a doubling of the rate, but if you look at the effect of what that will mean for people's actual tax liabilities, people's tax liabilities are going to go up 100% in many cases, right? Not because of the effect of the rate, etc. as well. So, but the biggest issue with this is the apportionment of that earnings. Even if we grant, it's quite the concession, we grant the concession that earning it through a gain is exactly the same as earning it through employed income, right? Even if we grant that, which is not even remotely plausible, but let's say we grant that, okay. The other thing is the realisation of that gain is a point in time that is not commensurate with. You don't get to say, well, you gained 100, but you did it over 10 years. Let's spread that over your marginal tax rates in those 10 years, or at least average it out. If let's take a tenth of it, see what tax will be payable that, and then multiply that out so that we don't throw you into high marginal tax rates in one-off years. So let's look at that. So this graph here, so this, again, this is Treasury, right? So this is the tax and expenditures inside. So this talks about capital gains tax in individual and trust. Now, so individuals and trusts. Okay, now not super funds, because it tends to use super funds differently, even though super funds obviously are trusts. But it's not clear whether this is saying trusts as in things like managed funds or unit trusts. I'm going to assume that's not the case, because I think this is referring to trusts as taxpayers. But basically what they're looking at here, and you can see here, this is a combined estimate of aggregate revenue foregone. So this is one of those things. It's the concession they're giving you by not charging you it in the first place.
Yep.
Okay. It's. I remember one of my clients said to me, it's a bit like requiring you to thank me for the times I haven't punched you in the face. That was his take on it. So you can see here around 830,000 people were affected in 2022-23 in terms of capital gains tax realising. Okay, so individual or trust. Okay, now here's the share of benefits and the number of people. So this is deciles, right? So 10%, top 10%, bottom 10%. Okay, so not surprisingly, there's very few people, and they got basically no benefit from capital gains tax, right? So all the benefit, and I'm pretty sure this is the one that flashed up on budget night that I saw, was a graph very similar to this, but this one's, we'll sort of make the point. So this is the highest, top 10% of taxable income decile. Okay, so who's not included in this? Someone with, millions of dollars in a super fund who isn't paying tax. They're not included in this. This is taxable income decile. So this is looking at tax returns, getting all the tax returns, so you have to be paying tax in the first place. So of the people who pay tax, the people who paid the most tax, right, the top 10%, the lowest 10%, where do they fit on this graph? Yeah. Okay, so let's have a look at this. Again, I want to talk about statistical categories of people, the top 10%, versus actual real people. And what type of people are living in this? Because look at this and say, oh, well, this is where the billionaires live, right? If you watch TikTok videos, right? This is where all the rich people come. Okay, well, let's look at this. Okay, so what happened here? So this is how much revenue they missed out on. We had this big boom in 22-23. It went from 15 to 23 because there seemed to be a whole bunch of people. And it's sort of, now it's forecast, because obviously these ones here are forecast, to be relatively flat, which is always a bit of a sign. It hasn't been flat in the past, but it's going to be flat in the future. Okay, that's fine. Okay, but look at the number of people here. So this is the amount of benefit. So this is 100% of the benefit, but you can see this blue bar here, which is the share of benefit, right? Okay, almost all the benefit, 80-something percent, 83%, okay, went to the top 10%. Okay, and there was quite a few of them. They were up to 230,000. See the number here. But look at this: 95% of the benefit was received by people above median income. Okay, so the middle income, median, not the average, but the middle, right? Almost everybody who received the benefit of this discount was above median income. Well, why is that? Well, because if a capital gain is added to your income, right, and that gain is even remotely significant, then for that year, your income, even if you're 10 grand below median income, you get a $15,000 taxable gain, you're now above median income. Next year, you're back to below median income, but in the year that you realise that gain, okay, so why is it so skewed towards this? Well, let's have a look at, here we go. Okay, so within the top 1% of tax filers by taxable income accounted for 54% of the capital gains tax income. So now we're down to 1%. So the top 1% had 54% of all capital gains tax income. Well, that makes sense, right? The people with the highest taxable income had the biggest gains. But have a look at this. I'll go back to this one. So they were 4 times more likely to realise a capital gain than tax filers not in the top percentile. In other words, you're only in the top 1% because you're realising capital gain. Mm-hmm. Everyone else isn't in the top 1%. So even the top 1% people aren't normally in the top 1% because if they're not realising a gain that year, they're being pushed down a bit. So really high income earners are often not in the top 1% because they just don't happen to be realising gain. Okay. Then tax filers not in the top percentile and had an average capital gain of $850,000 compared to $29,000 for other tax filers. Let me go through that again, right? Because within the decile, the top decile, right, the top 1% accounted for 54%. Okay, so in other words, the top, they got all the benefit because they had the biggest gain, right? So obviously, if you realise a gain of $1 million, your benefit's $500.
Yeah, sure.
The tax on that, right? So, okay. Whereas if you had a $2 million gain, $1 million benefit. Okay, so the size and the quantum, which is why if you realise an average capital gain of $850,000, so an average taxable bit of 400 odd, right? Because it's not clear whether that's a discount or whatever, but let's say it is. But 420,000 of additional taxable income in the year okay? So what income do you need to be earning to not be making a lot of money that year? Even if you have zero income. If you have $425,000 of taxable income because of their $850,000, you've sold an investment property, maybe a business asset, but probably an investment property for many of these people, right? The investment property they've held for how long? 10, 20, 30, 40 years, right? Yeah. They're selling and realising that gain in that 1 year. Suddenly, they're a very high income earner. They're in the top 1%. What will they be next year?
Not the top 1%?
Not the top 1%, right? So, have a look at by age. Okay, so this is the share of benefit, and this is the number of people. So lots of people getting capital gains tax discounts, but look at the relative share of benefit. 60 to 64. I wonder why there's all these people between 60 and 64 who are getting all of this realised capital gain. Keep in mind, they're realising the gain, therefore paying the tax. But because they're paying the tax, they're also getting the benefit of not paying more. Does that make sense? So what this rule is basically saying is, hey, rather than you realise $1 million capital gain and only pay tax on the 500,000, you need to pay it on the whole million.
Sure.
Right? That's essentially what the change is. Okay.
Yep.
At least 30%. Okay, if not more. Okay. So rather than that benefit of not paying tax on that 500,000 is what we're getting rid of. That benefit. Now you're only getting the benefit because you're paying tax. If you don't realise the asset, you don't have doesn't add to your income, you're not paying the tax. So you only get the benefit when you pay the tax. So you never sell the asset, you never get the benefit, and you never pay the tax.
Sure.
So, okay, so how do you stop that? Well, you change, we'll talk about the nature of the timing of the rates, etc. But this is all happening because you're triggering an event in a particular year. There's no indication of how long it took you, how much capital you had to play, what risk you took. All those other things are completely excluded from the equation to say, no, you earned $425,000 this year because you realised an average gain of $850,000, regardless of what your income was. Does that make sense? Why are you doing it? Well, because you're retiring. Well, you're getting close to retirement, right? So you're restructuring your fees, you're probably putting all your money in super, you're doing a whole bunch of things, right? So what are you selling? You're selling business assets, okay, or you're selling property. Who are you selling them to?
Probably these people.
You're not these guys, right? You're selling it to these people, aren't you? Now, maybe you're selling it to some of these people so they can give it to their kid, but you're selling it, you're transferring those assets to people.
Yep.
Okay, so you're either transferring control of your company, okay, or transferring control and or benefit of your property, or rental property, whatever it may be, right? But you're selling it and transferring on. You're clearly not selling it to more of these people because they're doing the same thing on average, right? So you're only rich because you triggered a one-off event. That might be your only asset, but you're now essentially, almost a millionaire in terms of earnings that year because of what you're gaining. So now that 850,000, instead of paying taxes if you made 425, you're going to pay taxes if you made, again, depends on how quickly you did that as to what that law of indexation is. Does that make sense?
Yeah.
So that's the difference. So it's conflating these categories of people and saying, well, this is clearly unfair because if I took the trusts version of that, if I took individuals out of that, it would still look like this in some way, right? It'd probably be even worse, right? Because most of the people who use a trust to do this will just have the quantum of money that's much larger. Okay. But does it matter this? It matters what's the average rate of tax these people are paying. Well, if they're realising a $850,000 gain, they're paying top margin rate for the vast majority of it.
Yeah.
Because it kicks in 190 grand, right? So for at least half, if not more of it, they're paying top margin rate on that money, despite the fact that it may be the only time in their life where they're even in the 30% bracket, right? So 37% bracket, right? So again, classic example of taking a statistical category and saying, oh, we'll see how unfair this is if it's the top 10% getting all the benefit, but it's really the top 1% because everyone else is realising almost none. But they're not the same people.
Yeah.
Same category, but they're not the same people.
Yeah.
So everyone goes through this and gets to do it once, right? Makes it look like that category is just raping and pillaging. Does that make sense?
Yeah.
So where this actually has another really pervasive thing is, okay, let's take this now and look at active trusts, right? So trusts that are trading. So you're running your small business through a trust as opposed to a company. Okay. So why do they want to put this 30%? This 30% thing is like everyone's got to pay 30%. Now that bracket basically kicks in at 45,000 income tax bracket. Okay. So in other words, as soon as you're over 45,000, you're paying that anyway.
Yeah.
As income tax. Okay. So let's say I've got a trust. How am I getting out of tax? Well, what I do is I stream to my children. Well, if they're under 18, they pay top marginal rates. I can't do that. So I can only stream it to my children if they're over 18 and not using that tax bracket themselves, i.e. they're earning less than 45,000 a year. Okay. So let's say I've got a wife and 2 kids. So there's 3 people potentially. If my wife isn't working, she's not working and my kids are adults. That's the first scenario, right? And neither of my kids they're both at uni. They're not earning any money yet. Okay, great.
Yeah.
How long are they going to be at uni for?
5 years, let's say.
Okay, let's be generous and give them 10, right?
10?
Okay. Well, one of mine didn't go and the other didn't go and he barely made 2. Anyway, but let's be super generous, right? And say, okay, well, these kids, they're career academics. They're doing PhDs. Had to find them, so whatever happens when you go to uni, right? And they do it for 10 years. So there's 10 years where they don't earn anything. So I can keep distributing 45,000 a year to each of my children so that they pay that same 30% bracket. And let's say Jill obviously does earn more than that, but let's say she's sitting at home as well. So there's a bit under 135,000 I can distribute. Let's say I would have paid top margin rate on it, and those are my business earnings. I would have paid that. So there's 135,000 that I'm actually getting that concession on compared to this new rule, right? But if I look at that and say, but if I have those 3 people who aren't earning any money, well, who's supporting them?
The government, presumably? Maybe? Oh, it depends.
How? They're not on job seeker.
True.
Because they're sitting at home, right? Or going to uni or whatever they're doing, right? So, and it's 45,000 per person. Now, if they're a normal uni student, I might get 3 to 5 years out of them before they're going to be earning 45,000. So there's going to be this tiny window, right, where I'm able to, and even, let's say my kids are, unless I've got a non-working spouse, it's one person that I'm getting that 45 discount. So for the first, say, 200,000 of my profit, okay, I might be able to use 1 or 2 or 3 or maybe even 4 people to distribute that out at less than 30%, whilst ever that window exists.
Yep.
Okay, but how long is that going to exist for any one person?
So under our scenario, 5 years at the most.
So even if I have multiple kids,
Yep.
and that spreads out over a longer period of time, again, the numbers are still the same, right, for each one. So the amount of actual tax revenue that I'm saving as a small business owner by distributing to those people, who I would be absolutely supporting anyway, it's not moving the budget. Okay, but why has that exploded? Okay, well, it's exploded because the number of people, where was that one? The number of people who are over that 30% bracket has risen so much. So the number of, back here, the number of people who had a trust was not that many. Well, guess what we've done a lot of in the last decade? Set up more and more family trusts, right? Not even as trading vehicles per se, but even just as investment vehicles, because so many more people are pushed up into that bracket. Okay, now, how many of them stay taking strong advantage of that? Almost none. Most family trusts morph into investment companies anyway, because company can tax at 30% and compound. A trust has got to distribute out, which is fine for the first 50 grand, 100 grand, maybe even 200 grand if you're going to have people for a few years. But after that, where's that trust income going to be? So we very often end up shutting those trusts down or transitioning into investment companies anyway. So again, you have this statistical category of income distributed to trusts and how much tax is paid on them versus those individual people. And so again, the analogy I think that works with this is like, it's a bit like saying we're sitting there, we're looking at the road statistics, and we're seeing that, hey, the accidents had by 17-year-olds has doubled in the last 10 years. Twice as many accidents now involve a 17-year-old as was 10 years ago. We think we've got to do something about that, don't we? That's terrible. It's twice as many accidents. Okay. And then we go and look at the data and we say, oh, but there's 4 times as many 17-year-olds now as there was 10 years ago, or 20 years ago, whatever the time frame is. So it's half the rate. Oh, they're travelling 10 times as many kilometres on average as they were 10 years ago. Because 10 years ago, no 17-year-olds had a car, like a couple of them. Now they've all got one, and they're going everywhere together, like on their own, right? They used to just jump in the same car before, and because one bloke had a car and 12 mates jumped into it, sort of thing. Whereas now everyone's got a car, right? So the number of kilometres travelled have gone up 10-fold. The population's 4-fold. The number of accidents went up 2. What should we do about 17-year-olds driving?
Nothing.
How much effort should we put towards that? Because it turns out by the time they're 20, they have less accidents because they're not 17-year-old. They're mostly blokes too, right? So, you know what I mean? So you can take a statistical category. Now, I made those numbers up, but they're not that far off the progression of, again, if you take demographics, etc., right? So again, we'll go back to when I was 17, a couple of my mates had cars and they were very popular, right? Whereas now everyone's got a car, pretty much. I mean, most people I know, their kids at certainly 18 have access to a vehicle, if not their own vehicle, right? So completely different world in terms of that. So you've got to look at the underlying statistics, particularly within those categories, and say, okay, well, if there's all these trusts taking advantage of this, well, how far are we going to let that go? Well, there's 12 million people working, something like that? Can't go past that, can it?
No.
Right? So, yes, this rate of increase is rapid, partly because you've locked in rates that forces people to take other action. So change those rates, you don't have to force them. Now, you might argue, by setting this sort of benchmark of 30%, everyone's sort of paying 30%. Okay, fine. Make the rules around that whatever you want. But keep in mind that whenever you're taxing income, you are absolutely dragging on productivity, right? And the other underlying thing in this budget was talking about we want to help productivity. But what you're saying is, if you grow value, if you make money, not earn it, make it. There's no guarantee of making money, because even when you grow your business, right? And I'll grab my business and I sell it for $2 million. Okay. Why is someone buying that business for $2 million? Well, they're buying it because they perceive that the way the business makes money, whatever it's trading, okay, we trade ideas in this business, right? People come in and we sell them ideas and we make those ideas happen. They give us money for that, right? It's the idea that that can keep happening that means someone will come and pay $2 million for this business, right? Okay. So they have to be convinced that that's a thing that happens, right? Hey, have you guys done that successfully? They have to be convinced it's a thing that will keep happening because they didn't make any money out of it yet. They're buying the opportunity to make that money. There's no guarantee that they will, right? So there's all that risk going into will they get any of that money over whatever time frame versus the straight earnings. They're not even remotely the same thing. And therefore, if you're going to incentivize one versus the other, then you have to make sure that the incentives are more for one than the other. And if one has such a penalty already as you probably won't get this, okay, you are absolutely going to disproportionately advantage. Why would I go and start a business when I can go and get a job? Right?
True.
Because the relative risk of that is off the charts compared to just going and earning money. More importantly, if you're going to be someone who's an entrepreneur, you're someone who's going to be putting your end capital at risk, right? Once upon a time, the business were mostly about physical capital. It was plant, equipment, machinery, factories, office space, physical. Increasingly, businesses are about intellectual capital. And intellectual capital is by far the most mobile capital. There are people making money on TikTok because people in Australia view it or Sweden view it or kind of whatever, right? Capital is now way more mobile than it's ever been in the past. So the idea that at any country, and we see this in the US with California versus New York, etc., versus Florida, the idea that you can just simply tax a cohort and your projection of revenue will be the same as you think because nothing will change. When I can go to New Zealand, across the ditch, as they say, right? There's no capital gains tax, okay? I can go to Singapore. There's so many different jurisdictions I can go to that are relatively similar to Australia. And as long as I don't end up with a necessary connection to Australia, don't spend more than 6 months here, for example, why would I have my business in Australia? If I could at all. Now, if I'm BHP, I don't have a lot of choice, right? But if I'm an ideas-based business. Now, as a licensed advisor, I have to be physically present in Australia to give advice, and I have to advise people who are in Australia. So my business is
locked in.
Stuck. But also, as we talked about, probably a net beneficiary of this sort of activity anyway. But if I'm starting up a essentially software, intellectual marketing, any ideas-orientated business, which themselves are more scalable and therefore potentially more valuable, why would I do that in Australia when I've just doubled the amount of tax that I will pay down the end if and when that. So the idea that giving a $20,000 permanent, instant asset write-off for small businesses is a great thing for productivity, not really, because that is also a physical asset business benefit. Okay. Most intellectual businesses will still probably get some degree of benefit from that anyway because they've got to buy some computers and bits. But increasingly, businesses will be intellectually based. Okay, and if I'm building a business that's essentially going to be a cash cow, I just want to do the work I want to do and I'll make a couple of $100,000 a year, but I'm going to be paying, I can't distribute that income in any other way. I'm going to be paying high levels of income tax, some of the highest income tax rates in the world. And even if I then have an enterprise that I can sell and realise some value from, I'm going to be paying the highest rates of capital gains tax in the world. Why would I run that business in Australia? That's a very, very real risk. And we're already seeing other jurisdictions around the world that have tried this and it failed. New Zealand brought in some tax changes a few years ago they had to reverse in terms of changing negative gearing. So, so negative gearing is the final component we want to talk about, right? So they've also said, okay, well, negative gearing, we won't have that now for anything other than new properties. And this is, I think, caged around the whole idea of this will help the housing problem. Okay, now we've got a whole other thing I want to do on housing because it's a kind of a deep dive itself. But if you look at, and I know this because I know builders, I know people who are physically building houses, right, and going through that. If you look at the cost escalation in houses, okay, let alone what can be and what can come out of the woodwork, but it is a reasonable estimate now that anywhere from generously say 30%, but it's probably closer to 50% of the cost of building a house today, okay, has nothing to do with the house. It's just to do with being allowed to build the house.
Yeah.
Okay, whether it's zoning or requirements or whatever it may be. Okay. Now, I was having this argument actually with Ben, who was a builder, right? And he was sort of saying, oh, well, he'd give examples of where, but people had this house built and it wasn't very good or had this issue, whatever. Surely you can't just be the sort of Wild West. And I'm like, okay, well, let's explore that for a second. So using my experience. So when my family moved to Queensland, we rented a house for a little while, and we got to the point where we couldn't afford the rent, right? So my father said, okay, what are we going to do about that? So he ended up buying it was a house that had been condemned, had been knocked over. He was able to like keep the core of the house, right? Chuck it on a truck and drive it out into the scrub. So we drove nearly 30 kilometres out of what was already a small country town. Literally in the scrub, bit of cleared land, put the house on stilts. That was our house. Moved out there when I was 7 years old. So there's me and 4 other siblings, so 7 of us in this house. He then, over the next few years, built more bits to that house to try and make it bigger. But when we moved out there, it had a kitchen, let's call it a dining room, and it had an open area that we all slept in bunks and kind of whatever. Eventually, he built some verandas on it, but that was our house. So we had an outhouse out the back. We had a dam that was about, I don't know, maybe 300 metres away that my older brother and I, we had buckets. We have to go and get buckets of water every day. That was our main water supply. We had a rainwater tank for drinking water, but we'd bath and everything else we do. My brother and I, we'd have to go and fill these 4-litre buckets. And so I used to have calluses across here from carrying buckets, right? That was our house. Because that's the only house that my family could afford to live in. We lived in the house for 5 or 6 years or whatever, and we finally moved back into town because we managed to gain enough wealth, and we ended up having to sell that house because it was the late 80s and interest rate hit 17%. So we sold our house for $25,000 and moved in with my mother's parents because we couldn't afford a house anymore. Now, I was finishing school, so I left. It wasn't really my problem anymore, but the only house we ever really owned was the house out in the bush. That was a condemned building, chucked on the back of a truck that drove that. And my dad, who had zero experience, very, very handy with his hands, carpentry, that sort of stuff. Like he can build stuff, but zero qualifications, zero experience in terms of doing so. He built a house for us all to live in. There is no way you can build that house today. You can't do all those things really very easily today. Anything like the cost thousands of dollars to do it, right? The biggest cost was moving the house out there on a truck. He was able to do it progressively, build bits when he could, because he was obviously working as well. So we had to take a bus into school every day, so we paid for that with however long it took me to get to school every day and back on the bus, because there was a bus that drove kind of past our house, right? So there was lots of ways we paid for that weren't physical money. Even when we moved back into town, we moved into a 3-bedroom house. And my older brother and I, we slept it was a sort of a semi-enclosed veranda. It's in Queensland, so it wasn't too bad, but we slept in essentially a veranda was our bedroom, and then we were separated by cupboards. That's how we ended up separated in bedrooms. Again, that house was like 0.05 stars, right? You just wouldn't be allowed to build that house today. Although we lived in it fine, until we couldn't afford to live in it anymore. You can't build that house today because you're not allowed to. It's got to be 7 stars. It's got to have this rating of that. It's got to be. This good friend of mine, as you know, is building a house up in Queensland at the moment, and the wind ratings and all of the stuff he's got to put into the house that he's building, when hundreds of metres down the road there are old Queenslanders that are 100 years old that are still standing. The house that my mother moved out of a couple of years ago, she was in that family home that we had to move in, so she lived in there until a couple of years ago when we moved it closer to town. That old Queenslander, one of the reasons we had to get her out of there is because it basically had no maintenance. Almost no maintenance over 100, what was it? It was just over 100 years they'd had that house. It was built in the 1920s. So that house had been there that long and had almost no maintenance. Yet that original old Queen needed some work, don't get me wrong, but the roof didn't leak, right? There's no way you can build a house today. Not allowed to. The cost of housing, because of what you've got to do to be allowed to build the house, and then what you have to build the house out of. The level of glazing, the quality of all of that stuff is the reason why house prices are, let alone the fact that the land itself is already, and everything compounds, right? So if the land's going to cost a lot, it's going to cost a lot to put the house on it, then the minimum entry price to a house now is $500,000 to $1 million, whatever it is, okay? Yeah. Which means it's the same thing. It's like putting a minimum wage in. If we make the minimum wage and we just say, okay, well, if everyone has a minimum wage of $15 an hour, how good is that? Well, why don't we make it 20? Why don't we just make it 50? Why don't we just make the minimum wage like a living wage? Why don't we make it $100? Okay, now let's ignore the productivity of where all that money comes from. But as soon as you do that, as soon as you price minimum hourly rate at $100 an hour, well, as a business, I can tell you, if I don't generate $300 an hour worth of value out of that, then I go broke. So I'm not hiring anyone who's not worth $300 an hour. Whereas if I can pay them $5 an hour, I only need people who are worth $15 an hour, right? And so the gap now between when you can start gaining the skills and experience to be useful, okay? Same thing. When you can get a house now, okay, that barrier is just being moved up and up and up. And the other thing it does, and this is the thing people don't understand about, again, I don't have a house price graph here, Ian. No. You look at median house prices. Well, what is that? So that's the middle price value sold in that year, right?
Yep.
You add all those up, okay. But think about a price sold. So you and I both buy a house in the same street, okay. We both pay $100,000 for it, okay. I renovate mine. I spend $200,000 on mine. It's now palatial estate, and I sell it. I only sell it for $300,000. So I already just got back what I put into it. What's the median house price in that suburb, in that street?
200,000.
Median house price. Only one got sold. Got sold for 300,000.
Sorry, I was counting you bought two houses.
No, so you and I both bought a house, right?
Yeah.
We both paid 100,000, so the median price 100,000. I renovated mine, sold it for 300,000.
Yeah.
The median house price just went up 300,000. Because it's the sale price of the house.
I get what you're saying. I was accounting for the two houses purchased.
Yeah. So you're talking what's the average, right? But it's the median house price. The median house price is prices sold. We don't know what the value of houses unsold is, so we just use the market rate. Now, it's not an unreasonable measure to use, don't get me wrong, right? But it doesn't account for the fact that how much capital got put into the house.
Yeah, 200,000.
I bought a business for $1 million and I sold it for $2 million. But I spent $40 million on plant and equipment. I lost a lot of money, right?
Yeah.
Same thing with a house, right? But that's not, in a rental property you'd account for it and claim it, whatever. But in terms of like accounting for the movement in prices, right? So everyone renovates their house in your street and then sells it, your rates go up. Because your median house price is being raised by the fact that they all renovated their house. Now, you might say, oh, well, I'm getting some wealth as a result of that. But what you're doing is you're pushing up the price of housing. You're pushing up the minimum cost of putting a roof over your head. Now, if we all want to go and spend millions of dollars making our houses nicer than they really need to be, that's a different argument. But if you're going to make the entry and base cost of the minimum, the house in the bush that I lived in, you're going to raise that as a consequence of doing things that aren't that, which all these other things are, let alone in terms of, the way houses are financed, etc., then you're just going to push up that level. And that's the problem with housing. The problem with housing is we're making houses expensive because of what we're requiring as a minimum viable product, if that makes sense.
Yeah.
So
sense.
None of this is going to address that. Negative gearing, removing negative gearing is going to make it worse. It can't not. Because if you think of what negative gearing does, negative gearing gives you a tax concession for the rental, which means you can afford more of a property than you would have been able to otherwise. Okay. Now, they're going to say, oh, well, you can carry forward those losses and offset the future income. So you may not end up with necessarily, mathematically, a different tax position. Because maybe you're now claiming that against rental incomes in years where your margin rate will be higher. So you might even be slightly better off. But the timing of that now has to change. If you can negative gear it and you can get a big chunk of money back, then you can do that earlier than having to wait until it's positively geared because you're able to put enough equity into it so that'll be positively geared. Does that make sense?
Yep.
So that's going to delay younger people building up those property portfolios or that asset base as a result of the fact that they can't negative gear.
Yeah.
Again, one final thing in terms of statistical categories, right? Rental properties don't normally stay negatively geared, again, depending on interest rate movements, right, for more than about 5 to 10 years. Because as the rental income grows and the loan essentially stays the same, if not being paid down, then they're now positively geared. So again, looking at the explosion, okay, in negative gearing is a result of two things. First of all, the value of houses going up so much. Second of all, the fact that those tax rates haven't changed, so more people have been pushed up into this. So look at all these people now that are claiming top marginal rate negative gearing benefits, whereas back here was no one. So it's a function of this again. Now, how long are they doing that for? 5 to 10 years. And then they've got to do another property. So again, you're seeing a statistical category blow out, but just because of the nuance of the number of people moving through that category. Right? So you're eventually going to get to the point where that's going to plateau, where the number of people getting that benefit's not going to increase because everyone who can is now doing so, and the number of people who are able to do so is not increasing because your tax rates aren't pushing more and more people into that category, and the demographics aren't pushing more and more population into that age bracket, right? So those two things, again, will take care of themselves, and they would definitely take care of themselves if you took out that marginal rate pushing people into that category. But that's why the effect of negative gearing and the concessions that people are getting for negative gearing have blown out so much.
Yep.
Is because so many more people are in that position. Okay, yes, house prices have been an effect of that, but house prices have been a function of what we make people pay for them in terms of making them, and also the fact that we finance them so, what would you say, preferentially. So the inflation in house prices is the result of banks being able to, partly because of relative interest rates, but also because of lending practices. Banks are allowed to, in fact, encouraged to lend way more money for residential housing than they are for any other asset. Okay, so that means that inflation is too much money chasing a limited number of goods and services, right? So if there's only money available for houses, by definition, you're going to inflate house prices as a result of that, okay?
Yep.
So that's why house prices have gone up so much, is because the amount of money to finance them. If there wasn't more money, the prices wouldn't go up, okay? If you and I both only have $200,000 to buy a house, that's all we can pay for it. We can only pay more for a house because there's more money available. If the bank says, no, you can borrow more money now, you and I can both pay more for the same house because we both have the relative borrowing capacity. That hasn't changed. But more money's available, so we can bid the price up. So that's a function of the finance system as opposed to anything else. But if you then make the cost of that thing as well, be the land or the construction cost, you're getting that kind of double whammy, and that's what's blown house prices up in Australia. The way to fix it is make them less expensive. And the way to make them less expensive is to reduce the cost of land, governments can control that, reduce the cost of making them that isn't making them, governments in control of that, and then reduce the incentive for banks in particular to finance houses as opposed to other things. Now that's going to hit bank profits, but it's also going to make houses a lot less expensive. And the problem with that is it's going to reduce the balance sheets of everyone who owns property.
No, I don't think it will ever happen because there's incentives all over the place for government not to have people have their property wealth reduce.
There's advantage.
Yeah.
Right? It gets back to that advantage versus interest. Okay, now, in reality, having a more expensive house does what for you?
Nothing.
Right? Because, yes, you can sell it for more, but to live where? Very few people, we're starting to see more and more downsizes now, but people downsize for two reasons. They downsize because they run out of money and they do need that capital, right? And part of the reason they did that is because so much of their money went into an unproductive asset over their lifetime as opposed to productive assets. They don't have more super because they paid so much for a house. Okay. Or their business wasn't able to expand because it cost too much to finance their business because it was way better for the bank to finance residential property. So there's a compounding effect of that people don't necessarily see. But you would see from a lot of our clients when they downsize, they just go from a big house to a small house. And sometimes it costs more because it's a brand new townhouse or apartment or whatever, right? So they don't necessarily downsize in terms of the quantum of money that goes into the roof over there. That's not anywhere near a pervasive phenomenon as people might think it is. People reach peak house and the value doesn't change a lot. The issue is how much of their capital, the human capital ultimately, which funds everything, has gone into the creation of that in the first place. And everything that goes into that, that is a zero-sum game. It can't go into something else. And the thing it can't go into, therefore can't compound. And so you've got 1,000 BHP shares, but you could have 2,000 BHP shares. That's made an enormous difference to the amount of wealth that you have, right? Because so much more money went into your house because the minimum viable house was so expensive, it's limited the amount of capital you had to do other things. So, all right. That's, okay. So, summary. The big thing that I think this budget hopefully will open up the conversation around is like, well, hang on a minute. How much more GDP do we give? Keep in mind that governments, that's just the tax revenue they're getting. They're already getting first bite of the inflationary, okay? Governments, and the reason why this budget is inflationary, despite what some people might even try and claim, is that governments spend money and then pay for it. And they pay for it, the deficit they pay for by printing more money. That's just a really simple answer to that. So printing money is literally the definition of inflation. The question is, are they doing that faster than the economy is becoming productive? Because it's productive in the economy, and you can check out our video on inflation when we talk about that. That's deflating things. If the economy can do that faster than the government prints it, well, then we don't get much inflation. That's the problem. And to agree, that's actually a problem. But the government's already getting that free kick of printing that money, spending the money first in today's dollars and then printing it later to pay for it. They already get that free kick. In addition to that, if they're then taking more of that revenue and putting it into, at the most generous sense, less productive activities than if it went to the private sector, then that's going to have a long-term drag on the economy. So hopefully this will at least spark a conversation around, what should tax policy kind of look like going forward, because we are still very heavily reliant on taxing income, taxing productivity, as opposed to taxing the other end of things, and that's raising the GST or whatever, but taxing at the spending end. Because if you truly are wealthy and you're spending that money, getting a proportionate share of revenue at that stage would be a much better way to go. So hopefully that's enough to answer all the myriad of deep dive questions. There probably won't be anyone who watches the whole video, but there's a number of questions in there that people had asked me that I wanted to make sure we answered. So that's our deep dive on the budget.
Cool.